Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. In today's video we are looking at two stocks that one of the brothers have actually asked me to look at recently. I think it was a while back, but I kind of forgotten about it. But today we are going to look at two different stocks that one of the subscribers have asked. When I created this channel, it was just to benefit everybody else. It's not just for me to come up with these stocks and share it with you every day. Ideally, it will be nicer if you can also ask, like as long as the companies are based in the US, in the UK, and there's a lot of research out there that I can easily find, then I'm more than happy to put it together and then give you my opinion. Again, this is not financial advice. I'm just putting these things together and then kind of share with you some of the facts about these companies, some of their financial metrics, see if we can actually add to their to our portfolios and so on. So it's really important that if you are thinking about certain stock and you don't basically know where to start, just let me know. Just put it on the comment section. Let me know. Just say, I might do like a 4 or 5 companies in one go. But in today's video, we're only going to look at two different companies that was basically asked recently. Now, what I'm going to ask you guys to do right now is just to click that like button, because honestly, it helps the channel so honestly, it's really important. Okay, I don't ask you guys to buy courses or anything like that. I'm not hiding. I've been sharing my journey with you since day one, every single week, whether I'm actually up or down, what I'm buying, what I'm selling. I've been transparent enough, I hope. Okay, so if you like that kind of thing and you like free stuff, okay, please give the videos a like, share with everybody else. And now let's get started. The first company we're going to look at is Align Technology. This is one of the leading manufacturer of a clear dental aligners globally. Okay, they have one of the best technologies out there called Invisalign. The brand is very well known around the world. It's not cheap. Okay, per treatment, I was just doing a little bit of research and I found out per treatment, okay, they have these invisible basically aligners, and they are quite expensive, from 3,000 to 5,000 per person per treatment, and treatment could last about 2 weeks, 3 weeks or whatever. So yeah, they are quite expensive. They have a really good product, very well known, and in terms of in the dental world, if you think about it. Okay, and I like the history of the story behind it, and the story behind it. So if you go to YouTube and just type, if you go to, I think it's CNBC make it or whatever, they have a little video about 9 minutes long, and they actually explain how the company came about, the Invisalign company, how it came about, and so on. It's actually quite interesting. I do these kind of things because I want to learn about the business. I want to understand what this business is all about. Okay, it's not just about the stock. So if you want to know about this that video, I might actually add the link on the comment section, so you can just click that. Really 9-minute video, very interesting. So the stock, as you can see right now, basically since the beginning of the year, it's down 56%. So it lost half of this basically of its market share at the moment. So that is quite interesting. Again, is because obviously it is a growing company, is a growth company. That's probably one of the reasons. And because of the technology company, all the tech companies have been down a lot this year. So in basically a year to date, about 56% down, 43% down in the last 6 months, and it's actually gone up. It's the last 1 month, so 13%, just like the overall market. Okay, but a year to date, again, 59%. In the last 5 years, if you bought this 5 years ago, right now you will be up almost to 66%. Okay, and that's quite nice, and this is what we normally look for. So if you're buying this stock today, don't buy it because you're gonna sell it in a couple of months. Okay, just buy it because you actually love the business, you want to hold on to it for the next at least 5 to 10 years. And if you can do that, that's perfect. So if you basically bought this stock when it came up in 2001, right now you would be up 1,500%, which is quite nice, right? So let's have a look at this stock itself. Okay, and let's look at the financials. Actually, this is not the one that we're looking at. That's the second company that we're looking at. So this is Align. Okay, it's in the healthcare, $280 per share, EPS about $7.81. Next year they're expecting almost 12, which is quite nice. Okay, market cap only $22 billion. it went basically down quite a bit, so I'm sure it was about 40 in the 40s. Okay, economic mode is narrow because obviously, like we always said, if a company has a narrow economic mode, that doesn't mean there are competitors out there, but that doesn't mean they are not basically the selected company that everyone goes to. Okay, so they can still have their market share, but that means other companies can easily introduce the same sort of a product unless they have a patent, okay, which will be very interesting to find out. Beta is quite high because it is in the is a tech company, is a growing company, so normally they seem to be a little bit volatile. PE is quite high as well, 36. Okay, basically the sector, the technology sector, is about 27 right now. And price to free cash flow is actually quite nice, way lower than the PE right now, 23, so that's quite good. They don't pay any dividends, but they have a free cash flow here of over 5 million. And again, for a growth company, that's very good. So that means they can reinvest in the business if they need to, okay, or pay back their debt and things like that. 5-year revenue growth, we're looking about almost a 30%, and this is probably one of the reasons why this stock is so expensive, because remember, when high PE normally means basically investors are putting a lot of, basically their expectation is that this company is going to grow their revenue massively in the next couple of years, in the 20s and 30%, right? And for that reason, they actually are betting on this company basically returning at least a 30 to 40% overall, and that's probably one of the reasons. Okay, 5 years EPS is growing as well, almost at 33%, which is really nice to see. Profit margin 17.5%, operating margins 23.5%, return on equity 20% almost. In the last 10 years, the company has actually returned 23%. That's really, really nice. And current ratio is perfectly placed. Okay, so that means the company has no issues in terms of paying off their debt in the next 12 months. Right, in terms of the growth, okay, this is another reason why the stock has a higher multiple. Okay, because look at this. The next 5 years, investors are expecting, analysts are expecting 43% growth every single year in the next 5 years, which is huge. Okay, simply Wall Street is actually saying almost 70% undervalued at the moment. Their price target is actually $911 per share, and right now they are 280. So that's huge. That's 70% growth, price appreciation in the next couple of years. Okay, Morningstar valuations almost 40% discounted at the moment. Fair value, their fair value is almost double from where it is right now, $461 per share. Tip rank is at 22%, $343 per share. That's their price target by the end of the year. Yahoo Finance also saying exactly the same thing. Their price target by the end of the year is $376 per share. It's moderate buy according to tip ranks as well. Now, this company seems very much undervalued in every aspect, and the fact that they are growing their revenue very much, quite high in terms of revenue growth. Again, that the fact that normally I don't worry too much about this, but when you look at the next 5 years, the expectation of 43% growth in the next every year in the next 5 years, that's quite high. That's very much the tech company, right? Now, the final thing we're going to look at is Sharia compliance side of things. The stock again is 99.92% according to Zoya. Business activity wise, Sharia compliant. Interest bearing debt, they have almost zero debt, and interest bearing securities, they only got 3%. So they are very much a very healthy company that's actually doing really well. I mean, these products they have, one thing I don't know about this thing is, right, I don't know how much basically if there's a demand for their product. Okay, if it's cyclical kind of business, is it actually, do people buy, do they have links with hospitals? I don't know these kind of things. So if you're interested in this business, then that's the research that you really need to do and find out who their customers are, who they basically link with. Do they actually have can you get it through your health insurance and things like that? So it's very interesting to find out a bit more information about this company. But when it comes to the financials, it looks really, really interesting, as well as the fact that the growth is there. That is undervalued at the moment. This is the kind of business that you want to buy. And I'm not saying to go ahead and buy it, but do your research, please. Okay, like you've already seen, the next company is Roche. This company is pharmaceutical company, is actually based in Switzerland. The stock is actually down almost 20% since the beginning of the year, which is quite interesting because the healthcare companies have been doing really well. Okay, but 20% down is not as basically it's not a lot. Again, it maybe gives us an opportunity to actually add this to our portfolios and whatever. So yeah, it is down, but last 6 months is down about almost 15%, down about 1.5% in just this month. But just last 5 days is down about almost 3%. For the year, 14% down. In the last 5 years, okay, if you owned it, you will be up right now about 30%. And then when you look at since the beginning, you're probably up about almost 50%. So if you bought it around 1998, right now you'll be up about 50% and so on. Right. So the other thing that you need to look at when you're doing this analysis for these sort of companies, especially the healthcare companies, you need to look at their pipeline. You need to look at how many products they have and so on. And this is the bit that I struggle with the most because I don't know what some of these products are. So again, you've got all sorts of products. So you normally product lines are like you've got phase 1, 2, and 3, and then you've got they file it for basically approval. And once this gets approved, then that's when they start selling the product. So as you can see in terms of pipeline, you can see they've got phase 3 products in phase 1, they've got 1 in phase 2, they've got loads in phase 3. So again, if any of these basically are successful, then it goes to, they file it for approval, and then straight away gets approved. And as you can see, some of their products have already been approved. And you just need to look at these in detail, what these products are. Do they have a patent? Is it just a new thing? Whatever it is, these companies actually rely on a lot on these pipelines. Okay, the products they have already out there are important, but the pipeline is very important because that depends on their future, basically depends on these type of products. Okay, so let's have a look in terms of financials. Again, like I said before in yesterday's video, RHHBY is the ticker that we're looking at. Currently trading $41 per share. I think the European one is slightly higher, so you just have to, the company is still the company, but it's just a different tickers, different things in different places. Okay, EPS right now we're looking about $2.31, and then when you look at the market cap, $272 billion company. Okay, they have wide economic moat, and they have a really low beta, which is quite interesting. PE is quite low. The sector we're looking about 21, but right now this is actually still at 17. That tells me maybe is actually undervalued at the moment. Price to free cash flow is slightly higher than the PE, so that means they might not have enough cash. But when you look at their cash, actually they've got $17.7 billion, which is interesting. So they do pay dividend, okay, 1.87 dividend. 5-year growth rate is about just 3%. I normally like 5% or more, but that's normal. Okay, 30 years of basically increasing that dividend. Okay, payout ratio only 47%, and it's 100% almost safe when it comes to that dividend. Okay, 5-year revenue growth, we're looking about almost to 4.5%. 5-year EPS growth is about 7.8%. Okay, again, pharmaceutical companies, I would expect a little bit more than that. Okay, this is what I would expect from consumer staples, but in terms of the revenue growth, maybe they've gone through a phase where they had a patent and that kind of finished, and they have to reinvest a lot of money maybe, and I don't know, this must be a reason. So that's one of the reasons that you need to look at the 10Ks from the last 4 or 5 years and get a feel of the actual business and how things are going. Okay, profit margin 21%, operating margin 31%, return on equity 44%, which is quite interesting, right? Total return in the last 10 years, we're looking about 10%, which is nice. Okay, current ratio is above 1, which is good. Now, next 5 years, the analysts are expecting 7% growth in terms of earnings. Simply Wall Street is actually saying 64% undervalued at the moment. Their fair price is $111 per share. Morningstar, 23% discounted at the moment. Their price is $55. And then when you look at tip rank, it's about 16% upside, and their price target is $48 per share. Yahoo Finance is almost the same, and then moderate buy from tip rank. Okay, so it looks fine to me. I mean, there's no red flags here. The fact that it has a wide mode, again, one of the things that I would be hesitant is just to just learn about what these things are. Okay, and if you know what these spinal muscular or whatever these things products are, then you then obviously have a massive advantage over people like myself who probably doesn't understand. Okay, and then when you look at the business side of it, 100% Sharia compliant according to Zoya. and 13.5% in terms of interest bearing debt. Okay, normally we're looking for about 30 or 33, between 30 and 33. Interest bearing securities, 5 points, again 4%. So again, really good company, is one of the biggest, I think, in terms of some of the products that they actually have. So you just have to dig deep a little bit more, find out everything about the company, how they make their products and what's in the pipeline, what type of products do they have any patents that's gonna expire in the next couple of years. And if that's the case, you really have to be careful. So one of the companies that I invested in, Merck for example, like they have a construed product called the construed, and I think their patent runs out very soon, right? So they have to now find it, because that means the other companies can now create the same product and start selling it. So you have to be careful when it comes to that sort of a thing, and just find out a bit more information about this. I hope this was helpful. Okay, I just wanted to share with you guys. And again, if you are sitting there thinking, I hope, I wish, if you have any companies that you want me to look at, absolutely send it. I will put them together and then I'll create maybe 1 or 2 videos out of it. That I'm happy to do that. Like I said, this channel is not just for me, it's for all of us to learn and grow, hopefully, as investors, and obviously bear in mind when it comes to Sharia compliance side of things. I hope you're having a wonderful day. Assalamu Alaikum. Take care. And if you haven't liked the videos yet, please do it now. Thank you.